Welcome to today's webinar. Today we're going to be discussing whether bonds are a better option than term deposits for long-term investors. We thought this would be a good topic as we often see clients regularly rolling over term deposits. They've been doing that for quite some time in some cases. They don't want to invest in shares, but they haven't really looked into whether or not there are any other options out there for them in that low risk category as an alternative, and that's what we're going to be focusing on today. I'm David Woolley, a partner in BDO Private Wealth here in Brisbane, and we have Ian Colyer on the line from Income Asset Management, who is a co-presenter of today's webinar. Look, I'll do a proper introduction shortly, but firstly, welcome Ian.
Thanks, David. Good to be here.
And great to have you here too, as as a specialist, on the topic of fixed income. We'll firstly do a welcome to acknowledgement of country. Just kick off by acknowledging the traditional owners of the land on which we meet today, pay our respects to elders past and present, and extend that respect to Aboriginal and Torres Strait Islander peoples here today. And also kick off by doing some housekeeping. If there are any questions, please feel free to submit those, and we'll do our best to answer those probably towards the end of the webinar. And if there are also any suggestions for future topics, please feel free to send those through. So as I said, I'm a partner here in Brisbane, BDO Private Wealth. My focus is providing investment advice and other strategic wealth advice to individuals and families. And Ian, did you want to say a bit about your role?
Yeah, so I work in our capital markets team at IM, focused mostly on assisting advisors, high net worth clients, wholesale investors, aged care and not-for-profit groups, just with very conservative investment requirements. So we'll cover off a little bit more as we go, but we really do specialise on a whole range of conservative assets, from cash, term deposits, right through to bonds and hybrids. So yeah, it was a really good opportunity to be invited along today. Thanks, David.
Something else we just should cover off in the start is a general advice warning. So please don't act on anything that we cover today without first getting personal advice tailored to your particular circumstances. Something else also should touch on at the start is that we'll talk today about investing directly into bonds. And just to clarify, that really is only available to wholesale investors. There are other options for retail investors that involve investing via a managed fund. So all of the content that we go through will be relevant, but just to make that clear that investing directly into bonds is generally only available as a wholesale investor, and to qualify under the current rules, that's based on having $2.5 million of net assets. If there are any questions on that about your own situation, happy to try and address those. But that sets the scene for today's discussion. So in terms of the outline, also we'll be covering off some fairly high level discussion about opportunities within fixed income in comparison to a term deposit. We will need to keep it pretty high level just given the time available. But that's the outline of what we'll be talking about today. So Ian, people may not know necessarily about income asset management. Would you like to do a bit of an overview of this slide?
Yeah, thanks, David. So IM, or Income Asset Management, we're listed on the ASX. The company initially listed in 1987 as Trustees Australia. 3 core business units that we work with. We've got I mentioned before, we work as a cash team in cash deposits and term deposits. We have a capital markets team. We also have a debt capital markets team as well, which helps organisations raise money in the bond market. We've got exclusively a wholesale investor base of approximately 2,000 investors. Across the group, there's roughly about $3.5 billion of funds under advice. Back in 2001, our CEO, our newly appointed CEO, John Lectie, basically went to reinvent the organisation from a cash and term deposit platform into something that now offers a lot more comprehensive income opportunities for wholesale investors. Last couple of years, we've announced partnerships with Netwealth and Hub24, helping to effectively make access to wholesale corporate bonds a lot more easier for advisors and their client base. That's what we've been focused on. So I did touch on before. I think it's, given the context of today's topic, I do really want to say from the outset, we're not opposed to cash and term deposit investments at the slightest. In fact, we've got about $1.8 billion worth of cash and term deposits that we assist clients manage. It's just in the relation to the topic today, it's more about what's an appropriate asset allocation for advisors with their clients, and also corporates and not-for-profit organisations, just helping them with their income needs. The three teams I mentioned before, we've got a cash markets team. We have access to approximately 50 different ADIs that provide rates at different times. Our capital markets team, we specialise in the bond markets. So there's typically over 500 bonds to choose from on any given day across investment grade, high yield, domestic and international. Major banks like the four majors here, although you could argue there's now 5 majors. And also a lot of corporates from other sectors and governments issuing bond markets as well. The capital markets team, that's focused on actually raising capital within that bond market, and I'll cover off on a little bit more of that later on.
Thanks, Ian. We thought we might open the discussion today, just looking at a range of different asset classes in terms of where bonds fit in. So here we're looking at Australian shares, international shares, real estate investment trusts, bonds, and term deposits. And we can see there on the on the left-hand side that shares have been the highest returning asset class over the last 20 years, and that that makes sense. There's high risk, high return. It hasn't been a smooth journey investing in shares. There is a lot more volatility investing into high risk assets like shares. Whereas on the other hand, term deposits being a very safe investment, you are getting the lowest return from those. And it's interesting that once you take tax into account, investors if you had been in a term deposit for the last 20 years, you would have probably made a negative return. You're just ahead of inflation, but once you take tax off, that would have delivered a negative real return. So not really suitable from a long-term point of view, which is I guess the essence of what we're trying to look at today in today's webinar. Bonds in the middle there at 4% is that's really reflective of the index, which may not be reflective of any particular investor's experience in bonds, and that's because we're looking at a composite index which includes government bonds, corporate bonds, and those government bonds generally the lowest returning, lowest risk part of the fixed income universe, and that's what that index is capturing. But certainly in terms of the relationship between risk and return, everything there on that chart makes sense from that point of view. Ian, is there anything you wanted to say on that?
Yeah, just to reinforce what you mentioned about the Bloomberg Ausbond Composite Index. A lot of people utilise and use this as a common measure for fixed income returns. It is a very, very conservative measure, so it is mostly governments and also to the we'll cover off a little bit further. It's also long duration. So what I mean by that is you don't get a lot of ability to basically take a view on where interest rate cycle is heading. So typically over a long period of time, that'll provide a very sort of average return. But as we saw 2 years ago when we're in an interest rate hiking cycle, those type of indices don't really have any capability to react to the current environment. So what we'll focus on a lot today is where we see value is actually looking at relative value in the market at all times. It's not just looking at an averaged or an index view of things.
Yep. Yeah, definitely agree. The other thing I could have said about this chart is just that these are probably the building blocks for a diversified portfolio, and a lot of our clients, we do encourage them to have diversification in their portfolio from a risk management point of view. The growth and defensive mix is the main way of, I guess, looking at diversification, and that's the role of bonds. Typically in a diversified portfolio is to provide that defensive income generating element in a portfolio, and how much you have or how little you have really depends on your risk profile. But these essentially are the other building blocks. Yeah, but definitely agree, Ian, about that. The Ausbond index, not necessarily being reflective of everyone's experience in fixed interest because of the way the index comes together. Term deposits, just have a look at those, and I guess one observation would be that they look pretty attractive at the moment, given the rates of the rates of interest which you can get on a term deposit. It's probably going to be in the 5s relative to where we've come from in recent years. That looks pretty attractive. They're also a very low risk investment, particularly if we take the government guarantee into account, which is $250,000 the government provides as a guarantee if you're having a term deposit with a authorised deposit taking institution. And that's worked out on a per account, per entity basis. So I guess if you're really keen on the government guarantee, you can spread it across a number of banks and use a number of entities and end up with a much larger amount of government guaranteed funds. If you're really risk averse, that's possible. It's probably, I think, one of the things we'll see today that it's suitable for short term though, because there are better options, most likely for longer term investors than to keep money continually in a term deposit. It also involves giving up a fair bit of flexibility because you're locked in and not able to withdraw those funds without an interest rate penalty and at least 31 days notice in order to redeem a term deposit. Ian, did you want to talk to this one?
Yeah, just wanted to highlight a lot is written about bonds in the AFR and various different other media outlets, but just to give clients and investors a bit of an idea as to the depth and size of bond markets. So in Australia alone, it's approximately $1.9 trillion in the Australian bond market, and globally a couple of years ago went past the $133 trillion mark. So we tend to always have a bit of a domestic bias as to what we do, and that's probably no different with our banking and deposits, and also in bond markets here in Australia. But there is, I just wanted to highlight that there are a lot of significant opportunities, not just for Australian investors, but also in international environment as well. So once investors start to become familiar with the value that's available in bond markets, there's an incredible amount of different optionality and value that's there for different investors, specifically to meet the requirements that they have for cash flow and asset allocation.
I don't have that statistic to hand, but it dwarfs the share market, from what I understand. The size of the bond market, and also I think it's considered to be the smart money. Is that true?
Yeah, it's interesting you should highlight that, because bond markets tend to be invested by institutional investors. So there's not a lot of sentiment and emotion attached to it. So yeah, so it's not, a lot of people would say it's quite boring and dull, which maybe it is, but whereas this see the ASX, there's different investments that can be invested based on momentum, based on sentiment. Bond markets tend to be traded on fundamentals. So typically advisors, accountants and clients that are really sort of looking through all of that noise and just looking at fundamentals tend to really gravitate towards the the cash flow calculations that bond markets provide.
Do you want to talk to this one as well?
Yeah, so just in brief, without labouring the point. So the purpose of bonds is really bonds are quite vast in the sense of the offering that's available. So you've got highly conservative bonds right through to high yielding bonds, but ultimately investors should expect to get their capital returned to them at the end or the maturity, or at some point through that maturity cycle. The bonds are often rated in terms of whether investment grade or non-investment grade. So there's a lot of information that's available to investors to actually decide what sort of bonds would be suitable to them. The predictable income, so fixed rate bonds will typically pay a specific amount over a period of time, and regardless of what's happening in the world around them, that rate will still continue to be paid throughout that time until maturity. There was also floating rate notes, which we'll cover off a little bit further, but they provide a certain predictable buffer against the prevailing interest rates. I'll cover off on that a little bit later. They're also, the reason why people gravitate towards bonds, they do provide higher income and liquidity compared to term deposits. Term deposits tend to have a set period before investors can access to them, and there's usually some form of interest rate penalty if they access those early. Whereas bonds actually trade in often fairly liquid markets. Investment grade bonds, for instance, will trade on most days, and all accrued interest is paid to the investor. So that does provide a lot of liquidity for the holders of bonds, and also of a diversification. So in Australia, banks do dominate the issuance of bonds, but there are also other sectors that issue as well. So mining, infrastructure organisations, insurance organisations. Like there's a lot more diversity that can be provided through a bond portfolio than, say, for instance, just bank deposits. Thanks, Tom.
I might just cover this one, which is really just a breakdown of the sort of bonds that are available in the market. To some extent, Ian's already touched on this, but at one level, we've got government and semi-government bonds issued by the Commonwealth and state governments. These are the lowest risk, lowest returning, safest sort of bonds that you can invest in. Corporate bonds issued by banks typically, and also other corporations. These we're starting to get, depending on the risk of the issuer, the credit risk starts to become relevant for corporate bonds, and as a consequence, there's a higher return paid as compensation for taking on a little bit of a credit risk. I say a little bit because in the investment grade corporate bond market, the risk of not being repaid your capital at maturity is very, very low, and we'll look at some statistics on that. But it's not zero. So there's some additional compensation in form of a higher return for investing, not just in government bonds, but investing in corporate bonds. But we really like the investment grade part of the market, generally speaking, and that still is very safe place to be investing, given that the chance of default is very, very small. The other two categories there to talk about asset-backed securities. This is a fairly sort of a generic sort of category, which includes any situation where a pool of, say, home loans are bundled up and sold as a security. You might have seen the term RMBS, which is important for particularly for non-banks as a way of accessing finance. So residential mortgage-backed securities. They've been a good place to be invested into. More commonly, institutions are investing here, and it's a bit difficult to generalize on risk and return because you've got a whole selection of different credit tranches you can invest into. Some even at that sort of the AAA level, so even more highly rated than typically the sort of securities that the major banks are issuing. And then lastly, we've got high yield securities, which we'll talk about later on in the presentation. And these are, I guess, slightly more risky type of bonds, but also, you're getting a return to compensate for taking on that risk. Ian, is there anything else you wanted to cover on that slide?
Oh, no, just to reiterate, I mean, without getting to sort of focus on the risk aspects of things, but all investing the basis should be the risk return. So, in all things, especially in bond markets, we look at the relative risk compared to the relative return. I think it's very easy for investors sometimes to look at headline rates, but not actually look at the risk required to get that. So what we look at on a daily basis is what amount of risk is required to get that return. And what we look at is anomalies in the market. So, for instance, like asset-backed is an interesting area of the market because you've got access to different credit tranches, and if you really know how to study risk assessment, you can actually get access to some really high-quality assets at relatively low risk, and that's part of what we do in that assessment process. Same with high yield debt. Looking at things like how the companies are structured, whether there's warehousing, whether it's set up within an SPV, whether there's asset backs behind that as well. So all of those factors are really important when putting all that together for a portfolio.
Yep. It's funny, just talking about risk there. I was just thinking about what risk means to most people, and I really don't want to oversimplify this. But often investing into bank shares, for example, is a fairly safe place to be according to most people. But if we just do a compare and contrast to investing in a bond, what is the relative risk? So if I lend money effectively by investing into a bond, versus investing into equity, I've got upside when I buy bank shares, but I've also got the downside, the fact that those shares can move up and down in price. If I buy a bank bond, the only way that I'm not, the real risk, in terms of the not being repaid at maturity, is all to do about whether or not the bank defaults on that bond, which Ian, I think, is pretty low in reality. So I guess risk is interesting, isn't it, for most people when you compare the risk they're happy to take on by investing in blue chip shares versus investing into bonds, where the chance of actually losing your capital, not getting return of capital at maturity of the bond is it's not zero, but it's pretty low.
Yeah, and you compare that to the four majors. Most people either directly or indirectly own equity in the four majors and wouldn't hesitate at that. But some may have a perception that a bond across the four major might be somehow perceived as more risky, when in reality it's not. So we'll cover off a bit more on that a bit further, Dave, and we'll show the capital structure and how that all ties in.
Yep. Actually, it's a nice segue.
So if you want me to cover this, so the major bank typical capital structure. So let's for instance, use the example of one of the four majors. Let's choose Westpac, for instance. So most people would, as I mentioned earlier, have a share, or have either direct or indirect shares in something like a Westpac. A lot of people will be familiar with hybrids. And also, a lot of people will be familiar with deposits, but they're probably not too familiar with the other stages of which, or the other tiers that bank capital structures operate under. So that slide there really shows you just the level of basically bank funding that happens for the likes of Westpac and the other majors. Deposits are well known. Senior unsecured debt and subordinated debt. These are areas that we study in markets quite frequently. So we're looking at market relative value on a daily basis, going up and down that capital structure. So at any given time, we focus on the fixed income side of the equation. So we're not licensed to provide general advice on shares, but we do provide general advice on the fixed income. So we'll look up and down that capital stack, and we're looking for relative value for an organisation like a Westpac versus also, how Westpac stacks up to other organisations and so forth. As you'd expect in a capital stack, the higher up you are, the lower the yield that you would receive. And the reason for that is if again, picking on Westpac, if Westpac were ever to default on their obligations, the way it works, it's like a waterfall. So senior secured debt and deposit holders will get paid first, and all of them are reimbursed before the next tranche receives a single dollar. So probably highlight a good example recently, which everyone's aware of, is Credit Suisse. So where that line in the waterfall stopped, ironically, was the hybrids, for instance, were not paid out. So they had a bit of a strange clause in there around that it didn't convert to shares. It actually was a write-off. So in that instance, hybrid holders lost their capital, but subordinated debt and everything above it, and quite ironically shares as well, managed to maintain all of their capital. So for a lot of investors, it's a timely reminder that the capital stack is very, very important when selecting what type of assets you want for the income you want it at. Because you're in that higher category, you might be giving up 0.5% per annum in yield. But if something were to happen to that organisation where there's a run on, and we're looking now at recovery stage, where you sit in that capital stack is highly important. So the numbers there on the right are just a bit of an indicative idea of yield based on this week's prices. Naturally, that'll continue to change, but that really does highlight, just why it is important to invest up and down the capital stack of one of the major banks.
I mean, everyone will be familiar about how they can access a term deposit, and similarly, how they buy shares. Do you just want to just talk about how they can get access to those other securities within the capital stack?
Yeah, thanks, David. So what we do is we provide that access to investors. So everything there in the pink categories, the fixed income categories, through advisors. Clients can actually invest that through ourselves. We can access all of those securities. So David highlighted before, it is for wholesale investors, although we do have some plans to make some of these instruments available to retail investors. But certainly at the moment, it is available for wholesale investors. And through the relationships they have with BDO, through the accounting team or the advisors, they can access, or they can contact us to access those markets.
Yep. And it's an over-the-counter market, isn't it, effectively for bank debt? So rather than trading on the ASX like hybrids do, you can buy and sell hybrid securities on the ASX. There's no equivalent of the Australian Stock Exchange for bank debt.
No, not for direct access. So it is an over-the-counter market, and something that you highlighted before, David. It is very much a non-emotive market. So the over-the-counter market is typically where institutional investors trade. So the large super funds, the likes of the future fund, institutional organisations, managed funds, and ourselves are participating in that professional over-the-counter market. Hybrids, again, we'll touch on it a little bit further as we go. We do see at various different times there's value in hybrids. At the moment, we are a bit hesitant around hybrids for a number of reasons, which we'll probably cover off a little bit later. But you're right, the hybrids are fundamentally held by retail investors. So there are times where, for various different reasons, people can be invested into hybrids that may not match the requirement that they're hoping to achieve being in a hybrid instrument. So as an example, I wouldn't consider hybrids to be part of a defensive portfolio because in the event of a bank coming into some financial stress, hybrids won't behave like a defensive asset. Hybrids are more likely to behave more like equity. So, for those reasons, there's various times where, accessing hybrids may or may not be beneficial.
Yeah, I definitely agree with that. So the slide is looking at term deposits versus bonds. I think this is one you put together.
Yeah, and it's just sourced from Bloomberg. So a lot of the data we use is from Bloomberg. It's just a really simple chart, just to highlight, just over a long period of time. So typically speaking, I think we all find that most people that invest in term deposits invest for anywhere up to that 1 year time frame. So, but a lot of investors then may repeat that process, and that may continue on for a number of years. So term deposits tend to be a very short-term mechanism. But even just going out and extending that time frame to 5 years and looking at, so BBB is an investment grade measure. So looking at a very conservative bonds instrument, and that's not just across banks, that's across corporations here in Australia and potentially globally as well. You can see that there's quite a lot of yield pickup that investors can get by just having a bit of a longer term view around what their income requirements are. And again, it's not to suggest that term deposits aren't appropriate, they are, but they tend to be more appropriate for a shorter time frame for that reason. And if people continue to invest in 1 year term deposits, then over a long period of time, they would expect to get probably quite a loss in opportunity cost relative to what they can access in for instance, investment grade bonds. And so touching on ratings, so that previous slide highlighted BBB bonds. So this is a bit of an example of, it's a bit of the graph on the right there is a little bit crowded, but it basically gives investors, if you cut down to the average line at the bottom there, it's the percentage of investment grade bonds defaulting globally across different ratings, so AAA, AA, A, and BB. So to give you an idea, since 2019, there's not been a single investment grade bond default anywhere in the world. Now, the rates for Australia tends to be even lower compared to global averages. But depending on where investors sit, again, in the ratings of their bonds, there's not been an A-rated bond default since 2009. So it does really highlight, again, it's never great to sort of focus on risk as such, but it really shows you the risk return proposition of bonds and how strong they are. There's also one of the things we'll cover off a little bit further. There's opportunities within those ratings. There's opportunities that arise. So a recent example are the major banks, Westpac, Commonwealth, NAB, and ANZ, recently had an upgrade in their Tier 2 subordinated notes. So they've now been rated A across, or A- across the board. So when things like that happen from a ratings agency's perspective, often there's opportunities in market to really highlight and focus on those types of securities. So going back to an earlier point where we're not really, as direct wholesale investors, we're not really interested in the averages of where markets lie. We're actually looking at the opportunities where there's potentially some missed opportunities, and that's one of those areas that we're highlighting for our clients at the moment. Is we believe there are opportunities in those major bank Tier 2 notes. The reason being is that we believe there's a good chance that they rally further given the relative risk nature. So it's not just about the coupon that's received, it's actually the value of that bond over time that we view as being highly important for investors. And we'll cover off on that a little bit further, Dave.
Yeah, it does seem like a bit of a sweet spot. I agree, that Tier 2 category. There's a couple of things though that I would just sort of call out on this slide. One would be, you know, those percentages are pretty low, and if you look at, I guess, the yield that you're getting on the investment grade bond currently, there's quite a bit of a buffer there. That if you did incur a loss based on these averages that we've got on the screen here, you're not making a negative return. You know, it might be a deduction from the total return on the portfolio, but you'd still be well ahead, you know, in terms of making a positive return, given where all-in yields are at the moment. Would you say that's true?
Yeah, absolutely. And also too, David, going back to the capital stack earlier, all that chart's showing you is default rates. It's not actually showing recovery. So there's a very good chance when you're sitting across AAA, AA, A, and even a lot of the triple Bs, that there'll be a very high chance of recovery, even if one of those organisations does default. So it's really important to highlight that. So although the default rates are very, very minimal, to provide additional comfort to investors is the fact that there is still a recovery process that would be undertaken. And so, in a lot of instances for, higher rated bonds, there would be a high proportional chance of recovery of their capital.
That's that concept of loss given default. Is that what that's touching on?
Yeah, but even just using the capital stack as the example. So, remembering the top levels get paid out fully before the next levels are paid out. So it's working through that waterfall process. So investment grade, typically tends to be the more not just higher rating for the organisation, but also a higher rating in a recovery situation as well.
It probably also highlights the benefit of diversification, doesn't it, Ian? Because there's no unlike shares when you're sort of positioning for upside. Generally with bonds, it's more about return of your capital and having an appropriate amount of diversification in the portfolio is a way of, I guess, managing default risk for most people.
It is, and it is a bit of a negative way to look at it, but that's our starting point. We look at capital preservation as first and foremost. So our client base, so we've got about 2,000 wholesale clients. They tend to be investors that are more conservative for that very reason. So the focus is very much on capital preservation. The vast majority of the returns that they should receive should be based on the income or the coupons paid out. But there are opportunities, and we'll touch on this a little bit later, but there are opportunities to actually make additional returns in market, which I'll highlight that a little bit further.
I guess this slide is just talking to what we just were covering in the previous slide, and we've also mentioned earlier the fact that corporate bonds receive a higher yield, and that high yield is linked to the default risk, which is, I guess, measured by the credit rating on a bond. That additional yield over a government bond is known as the credit spread. that credit spread, is part of the yield in a corporate bond, and it moves through cycles over time. Generally, when the economy is going well, credit spreads will contract, and in a downturn, a recession, then you'll see credit spreads widen because the credit spread is part of the yield, and there is a relationship between yield and bond price. So when the yield of a bond increases, then the bond's price will fall, and the flip side of that is when yields fall, then bond prices increase. So ideally, if you're investing into a bond, you want to be investing when credit spreads are more likely to reduce than they are to blow out. So knowing where we are in the cycle is an important part of investing into corporate bonds. At the moment, credit spreads have been falling, but they could still go a lot tighter from here. And a lot of that's to do with the fact that it's about what else is available for people looking for safe return to invest into, and that's also true from a global point of view as well, because Australia stacks up pretty well. Our debt markets stack up pretty well compared to other countries. Ian, did you want to say anything on this?
Yeah, absolutely, and probably a timely reminder that the credit spread is important from a starting point when you're looking at where to purchase, what to purchase, but probably less relevant over time if you do hold the bonds to maturity. So one of the aspects of bonds is that there's optionality in your favour, so that the valuations will change over time. But for investing in direct assets where a client or an advisor has full control over that portfolio, you can choose at any given moment whether you hold out throughout that period of volatility, or whether that's an opportunity actually to make some gains in the portfolio. So the credit spread or the credit risk does, it will change over time. But again, going back to the asset selection in the first instance and the organisations that are picked in the portfolio, if we're targeting the four majors and other organisations that have a very, very, very low probability of default, a lot of that volatility is smoothed out over time. Different scenarios will come along, but if you hold to maturity, all of the capital is then returned back to the investor. Again, so the guarantee is by the organisation that issues the bond. So if it's a Westpac bond, for instance, Westpac guarantees to pay that bond back in full at maturity. On credit spreads as well, that it also creates a lot of opportunity in markets. So where there's market movements, there's risk, but there's also opportunity. Our head of portfolio credit and strategy, Matt McCready, recently wrote on LinkedIn that the Tier 2 notes are currently under supervision with APRA, and this relates to their what brought about this review was the concerns around what happened with credit risk globally with the Tier 1 notes over there. So they're looking at, in Australia, they're looking at a review of how our Tier 1 notes or hybrids and Tier 2 notes interact, along with the bank's capital structure when it's put under stress testing. So APRA put the banks through a number of different stress tests recently. What they found was that equity and hybrids were quite heavily impacted, but Tier 2 notes, and again, coming back to the importance of the capital structure, the Tier 2 notes were barely impacted at all, so that the full income was still received by investors on those Tier 2 notes. So what we believe, in conjunction with the recent upgrades by the ratings agencies on those Tier 2 notes, we're of the view that those credit spreads will actually tighten even further relative to the other aspects of the capital stack. So again, using, for instance, like a Westpac note, our current view, and this may change over time because we're agnostic to market, we're just constantly looking for relative value. Our view at the moment is hybrids are a bit overpriced given the relative risk that they present, and there's a number of reasons why we view it that way, whereas Tier 2 notes are relatively undervalued compared to where they sit with the senior notes on a bank's capital structure. So with credit spread, we actually do see that as opportunities in market as well to target certain bonds and certain securities. But you're absolutely right, David, it's important to keep an eye on the credit spread. Well, what we do for investors, we do that on their behalf in conjunction with their advisors, and we monitor all that for them and constantly looking for where we see relative value.
And just to remind people, because we covered that a few slides ago, Tier 2 notes for major banks, what are they paying approximately?
Yeah, so Tier 2 notes, probably in the high fives, like mid to high fives currently, depending on your time frame. So the longer your time frame that you select, the yield curve is typically rising towards, you know, like the time value of money. So you'd expect to get a higher return when your money is invested in the longer term. But certainly you can target between that sort of 5.5. Some are sort of just below the 6%. There's been a bit of volatility in yields of late, given what's happening with interest rates. CPI announcements globally and in Australia. But typically you can get between that 5.5 and 6% return over a 5 to 10 year period. We've got a few slides coming up, David, that sort of highlights where we think term deposits may go in the short term. So in the one instance, bond yields, currently you get rewarded for longer term income investing, whereas term deposits are shorter dated in nature and likely to come down in price over the next few years.
Yep.
Yeah, so we touched on a little bit before, fixed rate and floating rate notes. So it's important to relate this slide. So fixed rate notes are really exactly as they say. So as a bondholder, you know exactly what the coupon will be over a period of time until maturity. These bonds tend to rise in value when interest rates are coming down, and conversely, they fall in value when interest rates go up. So we saw a couple of years ago, why I highlighted that earlier about the AusBond Composite Index is because the AusBond Composite Index is primarily all, it's something like 80 to 90% of it is fixed and long duration. So when interest rates move through various different cycles, which they will, in an interest rate cycle where rates are expected to go up, fixed rate bonds will actually underperform. So the ability to actually have a specific portfolio for an investor where you can actually target floating rate notes to help smooth out those interest rate cycles is really quite important. So with a floating rate bond, the name depicts exactly what it does. So the bond is then issued based on the credit spread, and then that credit spread is then paid to the investor over time based on what the prevailing interest rates are, or what's known as the bank bill swap rate over a given period of time. So as interest rates start to increase, a floating rate bond will actually pay a higher level of income. As interest rates fall, then the floating rate, the interest from that will start to decline. Given the nature of floating rate notes, the price volatility is typically a lot less. So it's really just the credit spread that impacts on the pricing based on floating rate notes. And the credit spread may be due to market credit spreads, or it could be due to that particular organisation if the market has a feeling that a particular organisation has their credit rating should underperform for any reason.
I think it's probably pretty intuitive for people about when you want to be in fixed versus floating. If your rates are moving up, you don't want to be sort of left behind in a lower returning fixed rate bond. You'd rather be in a floating rate bond. Similarly, when rates go in the other direction. What's probably less intuitive though is how the price of the bond changes. So when interest rates go up, the price of that fixed rate bond falls, and it has to fall because the coupon doesn't change. So it's dividing that fixed coupon divided by a lower price of the bond, so that when the yield is comparable with with what else is available on the market.
Yeah. On any given day, bond markets are highly intuitive to the data that's happening around them. So what I mean by that is that all the inflationary data that's available, all the news that happens overnight in America and domestically what happens here in Australia, markets are constantly forward pricing those cash flows. So bond investing is all about the value of future cash flows, and there's different ways we can achieve that for clients. We can because we're wholesale, we can actually speak with advisors about their specific clients' requirements to help them navigate their specific cash flow requirements and so forth. So, there's various different strategies that we can employ. I know it sounds like I'm a little bit against index investing for bonds. I guess that's my bias. I just find that number, that AusBond Composite Index number, is quoted quite a lot in circles, but it's not indicative of what clients' experience are. Certainly not the ones that we work with.
I think the evidence bears it out, Ian. I think there's plenty of evidence to show that index investing in bonds is not the best way to go, based on the research that I've seen. It's probably possibly getting into a tangent there, so we'll keep back onto the slides and
we'll continue on.
Keep talking about fixed or floating. So this is something you can access via the ASX. They work out what the market implied interest rate or cash rate rather, the RBA cash rate will look like this is out to December 25, and based on what the market pricing is saying, that the cash rate should be 3.88% by end of next year. So that's where the cash rate is going, according to markets. I think there's a 25% chance of an increase in the August meeting, but in 18 months' time, we should have seen a couple of decreases in the cash rate. But to your point, Ian, the fact that we know what the market pricing is telling us, unless markets move by more than that, then the benefit of being in a fixed rate bond is probably already incorporated into the current pricing of that fixed rate bond. That's what you're saying earlier?
Yeah, that's right. So in the absence of new information, that the markets have already reacted to the data that's available at the time. So probably if you move to the next slide, it probably highlights it even further. So basically, and apologies for the raw data. That's raw data from Bloomberg. So what that chart shows is that the dark green line is the current expectation around RBA rates will be over the next 3 years. What the slight yellow line indicates is that was the view from January 1. So why I wanted to show this is that the view has changed, but it's really only around timeframes. So there's been a lot of data in Australia. Our inflationary data, the last two prints of inflationary data have been higher than what's been expected. So what that's done is that's shifted people's expectations as to when interest rates will start to come down. But as you can see, the pattern is still very much the same. And if I was to show you that same data for US and a lot of advanced economies, we would see a very, very similar chart to that. In fact, even steeper. So in the US, the sentiment is around interest rates dropping even faster and harder than what we're seeing in Australia. So, highlighting a point we made earlier with term deposits, if it's short-term in nature, term deposits are highly appropriate. For longer-term investing, so if the strategy for a lot of investors is to literally do 90-day term deposits or even 90-day, 6 months or 1 year term deposits, if they continually want to just roll those over, at some point in time, there's a very strong chance that repricing risk will start to cut in. So instead of getting probably around about that 5% now that people are getting access to, it might start to drop down to 4.5% and potentially even lower. So when we see then the long-term returns that we can see at the moment on bonds compared to what the long-term projections are for cash, the gulf between the cash rate they're getting on term deposits and the returns they're getting on bonds start to widen more significantly. So this is something we encourage investors to do, is to really look beyond the current environment and actually just start to plan for further afield. So David, I imagine in your experience with the clients you work with BDO, there'll be clients at various different stages in their wealth creation, but there'll be other clients that are very much about income generating and capital preservation. So regardless of where they're at that stage in their life, there's still an importance of looking beyond the 1 year cycle. That we try and encourage investors to look beyond that 1 year and look for better outcomes with a longer term horizon. Of course, that's in keeping with their risk profile and asset allocation that yourself and other advisors with BDO would determine for their clients. But that's what we encourage investors and advisors to, is look beyond that 1 year time frame.
Yeah, no, I definitely agree, because it's good now, but I think there's a real risk you're locking into something that will mean that your options are a lot less attractive in 12 months' time when that term deposit becomes available, as opposed to locking into something now that's going to continue to deliver a much more attractive return over a longer time frame.
Yeah, and essentially we use the term locking in, and I must admit I fall into that that habit as well of locking in. With bonds, going back to an earlier point, bonds are highly there are a lot of bonds that are highly liquid. So investment grade bonds, although they might be for a given period of time, like 5 years, 10 years, or so forth, the option is always for the client through their advisor to sell those bonds and market at any given time. So really it becomes, it's like an annuity income stream, but the optionality is in the client's favor. So if the client, based on the fact that they're confident that that particular organization will pay back the bond at the end of maturity, There really is, the only concern then would be if they're happy with that level of income, but there may be opportunities then to actually sell down in market, or actually to if they need to access capital earlier than expected. Those opportunities are available to investors. It's not, bonds are not about locking up their capital for a period of time. It's just a promise by that. Yeah, I mean, I call it that trap all the time, David. I always say lock up, but it's really not a lock up. But the optionality is the client's favour as to when they dispose of that asset, or if they decide to hold it to maturity. There's a few examples later on to show you, when there's instances where there are actually additional value that can be had by actually trading bonds at various different times.
Yep. This slide we thought was important just to include when you're in relation to evaluating different fixed income investments. There's a few terms here that you'll come across. Running yield is one, which is very much like the dividend yield for a share portfolio. It's about the interest that the portfolio is generating divided by the portfolio value. So that's the running yield. What it doesn't take into account though is the fact that a bond may have drifted away from the par value that it was issued at. It might be above or below $100 in terms of the par value. And so the running yield isn't taking that into account, because if you buy a bond at less than $100 and you're repaid the $100 at maturity, then that's a part of the return that you receive. And I guess the flip side of that is that if you buy a bond at a premium and you're receiving the face value of $100 back at maturity, then that's taking away from your return. So that's included in the yield to maturity, which is that second way of working out a return on a bond, which includes the premium or discount as part of that return calculation. And then alternatively, it might be a backward-looking return measure. So what is the portfolio generated over the last 1, 3, 5 years, for example, in terms of the actual return that the portfolio has been generating. Ian, did I miss anything there?
No, just to highlight the first few measures, running yield and yield to maturity. That's something that we look at pretty regularly for clients, because bonds really are, or capital markets really are about valuing future cash flows. So on any given day, the particular securities that they hold, it's all about looking forward as to where those cash flows are valued currently in their portfolio versus what's also available in market. And going back to reiterate an earlier point, there's instances usually in market where we could potentially upgrade the cash flow in their portfolio. So rather than an investor feeling like they're literally buying a bond and holding it for the next 10 years, invariably there'll be different opportunities that arise that they can actually upgrade that cash flow. And then what happens is over time, that adds to the actual returns, the actual performance. So you're right, the actual returns is really backward looking, but what we aim to do is actually increase that over time with a constant focus in market as to where those cash flows are being valued. And there are many instances, I'll show you one, there's many instances where you can actually get increased performance. So yeah, so the Westpac Tier 2 note that issued late last year is a very good example. Number of reasons why this has rallied in market, but this was launched in market on the 8th of November 2024. We could see very easily based on relative values. So what you're seeing in that chart there, and apologies for the raw data, this is Bloomberg, we can see relative value very easily based on the other 4 majors that were issuing a Tier 2 notes at that time. So that red line, what that depicts is the yield curve for that particular security for the 4 majors. So we're tracking different securities across that yield curve, and where we see an outlier, we can have a lot of confidence as to the relative value. So that particular bond or that note that was issued was a 15-year note, but it's callable after 10 years. So typically the 4 majors will call their securities when they fall due. So really we can treat that from a pricing point of view as a 10-year bond. It's very, very rare for banks to not call their instruments when they're due. And if you go to the next slide there, David, just to highlight, so what happens, so we've got a facilitation desk based in Sydney where we're monitoring these types of transactions as they arise. The order book was in excess of 2.34 billion, so it was oversubscribed. The deal size in total was 1.5 billion. There was actually further order book demand for that particular one in excess of the 2.34. So it was roughly 1.5 to 2 times oversubscribed. The spread, so going back to an earlier slide around credit spreads, so the credit spread for that particular instrument was 240 basis points over. So that Bloomberg slide on the previous, chart on the previous slide really shows where we could see that relative value. So this is where we look at credit spread from a pricing point of view and where there's relative value. The yield on that was highly attractive, so it really was right at the peak of the yield expectations in markets. So that was effectively a 10-year note priced at 7.2% from a 4 major. So it was the first time in many, many years that one of the 4 majors printed a tier 2 note at over 7%. So as you can imagine, a lot of demand from clients. Now, given a number of factors, one is the yield environment has started to drop a bit. So as expectation now mounts around interest rates coming down further, so yield expectations are coming down. We've also seen a contraction in that credit spread. So, to highlight that point from earlier, David, about why we track the credit spreads. So that 240 basis points now has come right in. So that's an opportunity for that particular bond to rally in price. So as at yesterday, that was trading in market at about 107.56. So bear in mind, a 7.2% return is, so if we were looking at the various different measures of how to value a bond, if we were looking at a yield point of view, it's a forward-looking yield, and the client, if they purchase it on that day, it was 7.2%. But as of today, if they're still holding that particular bond, the holding period return, so they would have received a total of 12.24% on that, and the annualized return would be in the vicinity of about 18.39%. So there are instances. Yeah,
it's a really interesting example, because I guess here we're looking at the actual performance that somebody has benefited from. Had they purchased this bond, on issue over that period of time since November last year. Looking forward, though, I guess this is when those concepts of the running yield and the yield to maturity sort of come into play, because I guess the price of this has moved up, the income has stayed the same, so the actual return that somebody's getting is kind of moved back in line with market. So we're probably seeing what a sort of a 5.5–6% kind of yield to maturity on this.
That's right. So what we'll look at now, we'll look at the relative. So looking at the price at 107.56. So we're constantly looking at relative forward value. So as an investor, that's all we can really ever do. What's in the rear vision mirror, you can learn from it, but you can't gain from it. So we'll look at that on any given day. So at 107.56, we're looking forward to go, okay, what is the yield to maturity at that price, or the running yield, compared to other securities or similar securities in the market, rated at A-, for instance. And there's opportunities that arise in market to potentially, crystallize the gains on that particular note, and then potentially purchase another note that's showing better forward-looking cash flow projections. And that's how, and that's how, as a bond holder, as a bare minimum, you're getting that, that forward-looking coupons, or the yield to maturity, or the yield to or the running yield. But there's options to upgrade that cash flow over time. And we're certainly, in bond markets, it's certainly not, high frequency trading, or, it's usually opportunities may arise, from time to time. It's not necessarily frequently, but when opportunities do arise, it's a really good optionality for that client to actually crystallize those gains, and potentially also increase their cash flow, projecting forward. So if we're looking at it as at today, what's the best form of cash flow that client can achieve based on their risk profile? That's what we're looking at, daily in markets. And obviously, the Westpac one's obviously a bit of an outlier. It's occasionally you get those sort of securities that come along that just you know it at the time that it makes a lot of sense, and then over time it becomes even more apparent that more and more people should have invested into it. But as a guide, what we do provide, our head of portfolio and credit strategy, Matt McCready, he provides a model portfolio on our website to give people a bit of an indicative guide as to where to start from. We do update that from time to time. It's a bit of an indicative portfolio, but given the environment that we're in, so as of 31st of March, the forward-looking yield to maturity was 6.17. That's since come down, but last calendar year, that returned over 10%. Now that particular portfolio, it's all investment grade. It's very conservative. It's mostly major banks and corporates. But it does give you a bit of an indication as to even a little bit of ongoing management and positioning the right securities when you compare that to the relevant index, which I've shown the chart there, even in an environment where yields are coming down, that has outperformed that index considerably over that time frame. So with fixed income, there's not necessarily highly active management, but there is a degree of active management that happens to make sure that the future cash flows are optimized as best as they can. We focus a lot today on investment grade investing for good reason, because there's a lot of clients where that's suitable. There's a lot of clients also, or investors, that really want higher income opportunities as well. So this is where we get really granular with our credit teams in Sydney to look at the risk return parameters. So some of these bonds are issued by very large organisations listed on the ASX, but the income from those could vary between, say, 7.5% right up to 14%, given on where that bond sits by the particular company that's issuing it, whether it's a senior bond, where it's a subordinated bond, how the asset backing is structured, and so forth. So part of what we do is also help investors with those higher income opportunities. So it's not just that 5 to 6% investment grade returns or yield rather. It's also looking at other bonds that pay a higher amount of income. We touch on that. Naturally, our bias is around direct ownership, but there's a lot of reasons why we believe that's a lot more beneficial for clients that can access a wholesale market, given, for instance, or as opposed to managed funds and ETFs. There really is a high degree of flexibility and concentration that you can put into a portfolio, so you can have a lot of high conviction in these types of portfolios, and you can match the securities to match the client's specific requirements. So not just about individual clients, but around corporations that have very much known cash flow requirements like aged care, not-for-profit groups. There's a lot of benefits in actually positioning a portfolio specifically for that client. Did you want to touch on this, David?
Yeah, I'm conscious of kind of almost on time, so I'm just going to gloss over these last couple of slides. But I guess in summary, there are other options. You do give up some flexibility investing via a bond fund, a managed fund, or an exchange-traded fund. But that is another way to access the different parts of the fixed income market that we've spoken about today, particularly for non-wholesale investors. But all of the active management strategies, which Ian's touched on already, that is one demonstration of why direct investment into bonds can be much more suitable, particularly if you want to hold to maturity as well. That's the other key benefit of investing into direct bonds. So in summary, there are other options out there beyond term deposits, particularly if you're investing for longer than 12 months. Fixed or floating is a key decision when you're investing into fixed income, and we've already touched on the fact that the RBA is most likely to be cutting rates, which is an environment where fixed rate bonds are more likely to be the better place to be. It's not an all or nothing decision though, and you can have a portion in both fixed and floating. Investing directly into bonds does provide a lot more flexibility, particularly certainty of cash flow is another example. But you can access fixed income via a managed fund or an ETF, and then there's that issue of diversification as well in relation to that. Look, if there are any questions, we'll do our best to get back to people individually on those. We've sort of run out of time for today's webinar, but thank you very much for your attendance, and please look out for further webinars in this series. So, thanks very much. Thanks, Ian.
Okay. Thanks, David. Thank you.